first of 4 sessions. The concepts that we'll cover today are basically identified in our agenda here. So our direct costs versus indirect versus operating costs, direct cost types versus direct cost type or direct cost groups, and direct cost versus direct non-job type GL accounts, and then our over under allocated indirect costs. So we'll cover several accounting concepts and loaded labor factor concepts. We'll cover several accounting concepts and we'll tie it into the system. Okay. So the way we'll cover the course is we'll have our concepts, and we have a list of questions basically that we'll address, and by answering the questions we'll cover the material. And as we cover the material, we'll tie into the demo database. So the first concept is how many direct, or question is how many direct cost types are allowed in the system. A direct cost type in this system would be labor, material, sub-equipment. Other would be somewhat of a standard direct cost type. In the system, in TimeSuite Toolbox, you can have as many direct cost types as you want. So there is no limit. As far as the groups are concerned, there's a fixed number of groups that you can have in the system, and there are 5. Each cost type falls underneath a cost group. So if I want to add another labor cost type, I just basically add it. Okay? Now I can delete it as long as I've got no transactions against any of the types. When you create a general ledger direct cost account, it requires a type. So if it's a direct job expense type account, it'll require a type. And these are the same types we saw in the drop-down here. So if we add a type, then we'll see that show up here. See the material 2 now? The reason there are a fixed number of groups has to do with somewhat of the industry standard reporting concepts. So a lot of the reports in the system you'll see across the top, you'll have categories of labor, material, sub-equipment, other. So we'll run this particular report. So here we have labor, material, sub-equipment, other. They have to do with the cost groups. So the way we know what columns the items go into, like material, and material 2 will go into the material column. Directs and reimbursements will go into the other column. Okay. The way these cost types end up on transactions is through the GL account you select. When you have direct job expense accounts, you select a type. So if you have an AP invoice that goes to, this is 5,100 subcontractors, it knows it goes in the sub column through that association. As far as the budget's concerned, if we go into the system, into one of the projects, and go to the budget tab and click on any of the codes, the cost types show up here. Remember the material 2 we just created? So your cost types are here, and then that's how you select your budget, or put your budget together by cost type. So under Utilities Preferences, Burden, it identifies the cost type, and you can select burdens by cost type. This is one of the many areas you can identify burdens by cost type. So the cost type concept can show up in other areas as well. It's just the basic concepts. So how many direct cost type groups are there in the system? And we said 5, labor, material, sub-equipment, and other. There are 3 general types of cost a project-oriented entity will have. They're direct costs, indirect costs, and operating costs. Operating costs sometimes are called G&A, general and administrative expenses, or sales, general and administrative expenses, or SG&A. So if we go to an income statement, the demo data is in January, basically. So if we go to an income statement and we look at we have our revenue, then we'll have our first major cost type, which is your direct cost, or what do we call it? General types of costs. So we'll have direct costs, then we'll have indirect costs, and then we'll have operating expenses. Okay. So direct costs are job-specific costs that can be directly assigned to the jobs. Indirect costs are job-related but difficult or impractical to assign to the jobs, and that's the definition of an indirect cost. And then the operating expenses are not job-related. So 3 general types of costs in your income statement. So what is an indirect cost? An indirect cost is a job-related cost that is either difficult or impractical to assign to a job as the cost is incurred, assigned directly to the job. So what we do in accounting is we apply those costs in some reasonable manner. For example, we might burden those costs onto the projects. So in some systems, payroll taxes can be an indirect cost type. In our system, the payroll taxes, as long as we know the percentage of the percent, like FICA would be 7.65% for the Social Security and Medicare, or FICA, 7.65%. The workman's comp rates will be here. And the general liability insurance rates, if you pay general liability insurance based on labor, will be here. These are your effective rates that need to go in. So we know those rates. If you set up payroll adjustments where you identify a rate like 401k, 3%, for example, is what this is set up. And you could override this at the employee level, but as long as we know that percentage, either at the employee level or the payroll tax adjustment, then it's going to go into the direct cost section. Okay, and then the burdens are going to be reflected in the direct cost section at the bottom for the items that are being allocated out of the pool of indirect costs. So an indirect costs, the indirect cost section sometimes is referred to a pool of costs. So the costs come into the pool, and then they're applied out of the pool and up into the job. So here is, for example, some heavy equipment or equipment getting applied out of the indirect section and up into the jobs. And so the numbers are the same, and that's what you would expect. Here is a percent burden allocation coming into the pool of direct costs and out of the pool of indirect costs. So we have several ways to burden in the system. The keep it simple way that we promote is to do it just based on labor, and you would come up with a percentage and apply it here. And so moving forward, it'll apply into the system. When you put a percentage in here, it never retroactively burdens. If you want to retroactively burden, you'll use the burden utility grid, which is under the project management job list. There's an icon that you can click, and you can burden your indirect costs retroactively. And that utility can burden indirect costs many ways. So it's very in-depth. We have probably 5 to 10% of our customer base uses that to burden their jobs on a regular basis. Maybe half of our customer base will use that burden utility grid to retroactively true up the indirect costs maybe to the beginning of the month or beginning of a quarter or beginning of the fiscal year so that your over-under allocation goes to 0. And some people don't do that. But anyway, so your indirect costs, your job cost in the system will tie in here to your 107,330. So if we look at one of the reports we ran a little bit ago, here's a billing, direct costs, and burden summary. This particular report will show the costs that have hit from the date range that we specify. Each of the projects by type, the labor burden is here, the percent burden, and we'll cover these concepts and how this happens within the system, and it'll cost and billing. Below this particular report, we recap the income statement, but the same types, or actually these are cost groups, direct cost groups. So the labor that hit the income statement is here, the labor that hit the job cost is here, and the general ledger versus billing cost differences are here. Now before you accrue wages, there'll be a difference here. So when you do this process, and you should be doing this at the end of every month, it's going to sync your general ledger up with your job cost, or your job cost up with your general ledger, I should say. The job cost reflects the work date or the time card entry date. The general ledger, like any general ledger system, will reflect your labor as of the check date. Because you might have labor in one month that was paid in the following month, like for example, if you had labor worked in the last week of January that was paid in February, February will get the job cost in the general ledger as of the check date, which is in February. The job cost will be reflecting the labor as of in January. So to sync the job cost up with the general ledger, you have to accrue wages. And that has to be done perfectly, and it's a daunting task to get everything, FICA, FUTA, SUTA, work comp, general liability, 401k, whatever else you have that is associated with each time card row. To do that perfectly, it really needs to be automated, so that's what we've done here. The reversing entry is done for you as well. So it syncs your job cost up with your general ledger. So how do most companies apply indirect cost to projects? And the answer is labor. So the vast majority will apply it based on labor. So in that light, we've produced a report here, GL direct costs and burdens. In this report, we've retrofitted for companies that don't necessarily apply their indirect costs based on labor. Now, you can have different types of indirect costs. If you have heavy equipment, you'll have an indirect cost pool for heavy equipment. And you might true up your indirect cost over under allocation relating to equipment. You might use your equipment cost to do that. So if you don't, you could have, we have a plant section, sometimes a manufacturer or a ready mix, asphalt, rock crushing plant operation will have a plant section, and the plant section will have an over under allocation, and you'll deal with that maybe based on material coming off the plant. But for the most part, I think if you're not dealing with equipment and plant, you're just going to have costs that are like field vehicle expenses, maybe health insurance for your field employees, those kinds of expenses, maybe shop expenses, shop supplies, and those kinds of expenses that need to be allocated off of the job and into the direct section. Even if you have small equipment, for example, you might have a skid steer, you might have field vehicles that can get depreciation, so you'll have depreciation on those vehicles and skid steers, small tools that hit the indirect costs. The estimators will always account for those in the estimating process. The accounting process has to support the estimating process. The one thing that the estimating process sometimes has to allow for is that there are no transactions that hit the accounting process. So the only way to get those costs out of the indirect cost section and onto the projects is to burden them onto the project in some reasonable manner. They can be burdened on labor, direct labor dollars. They can be burdened on a unit basis. But generally, people are trying to keep it simple. So here's a report that will calculate a typical direct cost section. Here's your indirect cost section. Same thing we just looked at with our totals. This report breaks that. Instead of having the less burden down here, it puts it in a separate column so that you can see this is really the total direct costs. That's the indirect cost that was allocated up to it. And then you take that stream of costs. There's an allowance for the burden that hits the accrued wages, and then we add back this 3677, and we get our this is really our indirect costs, our total indirect costs. And we divide that by direct labor here, 13057, and it gives us a percentage, so 65% in this example. And you can run this report on your income statement and see kind of how it lines out. This box down at the bottom is really a nice tool because it'll tell you your payroll taxes. So this company has 11.44% in payroll taxes, FICA, FUTA, SUTA, work comp, general liability, or FICA, FUTA, SUTA, general liability, and work comp are in this line item in this sample database. So 11.243%, and then we have something else coming in here, maybe a 401k. And then we have indirect burden to labor, and that's the 65.21 that we calculated here. So if we true this up, it's really 89. Our total burden is 89%. 1.8972 would be our average burden rate. So the average gross wage times 1.8972 is going to give us our loaded labor factor. And that's a number that the estimators are always very interested in. They don't always throw that additional number on your indirect costs. A lot of times, like I'll have conversations with them and I'll talk them into doing it. They might put line items in their estimate for the skidster, for the field vehicles, but when you put line items in the estimate for those type line items in the estimate, you can't get costs back through the accounting process unless you do some sort of maybe fixed asset transaction. So anyway, so to pick up these indirect costs as a labor concept does make sense generally. The field equipment, the health insurance, the field vehicles are generally used by the employees, so there's generally a direct correlation. So whether you're a subcontractor, general contractor, heavy highway contractor, the engineering firms don't necessarily. A lot of project-oriented entities don't have a lot of this kind of costs, but most do actually. Some don't, and some do. So if we were to put 89 or 65.21, if we would have done that at the front end of our period here, 65.21, we would have come up with 0 over under allocation here. So we bring up the .NET job list, and we go into the burden utility grid. And this grid needs to be customized, so we can eliminate some unnecessary columns. You can allocate in a lot of different ways on this grid. I think we don't want to we don't want to spend any time on the grid other than we want to allocate those over and around allocated costs just so that you see how it's done. So the report told us that we needed 65.21309. These .NET grids, you can tell them to just show 2 decimal places. If you highlight it, it'll show you everything, but it didn't actually round it, even though it displays as 2. So we'll say cost group cost based on, and then we'll say based on labor. You have to check that box. Sometimes people forget that. We'll say execute, post. Retroactively allocate the indirect costs. Now, you should see a small difference after you've retroactively allocated your indirect costs, and you won't come out to zero because your accrued wages changed. For example, the burden on the labor that was accrued has changed now. So the labor that was worked in the last week of the month got reburdened, right? And so when we accrue wages, we accrue those burdens into the income statement, into the general ledger. So we have to repost the accrued wages for it to perfectly accrue that burden. So this is reaccrued the wages for the adjusted burden. Now we come out to zero here. And we come out to zero here, or 3 cents. So that's retroactively allocating your indirect costs. You'd never want to do it beyond the beginning of your fiscal year or a period where you've closed the books. So go back to our concepts. What rate do estimators apply to labor hours in the bidding process? And so they apply a loaded labor rate. So the indirect cost allocation process. So one question that that you can pose is, how do I know my job costs are correct? And how do I reasonably rely on my job cost? And the answer is, if you tie your job cost into your double entry system of accounting, double entry bookkeeping system or accounting process, and then your balance sheet, you can prove your numbers in your balance sheet because everything can be reasonably substantiated. So you go through a process called a month end where you do a set of work papers and you do a bank reconciliation on your bank accounts. You do an aging, look at the agings on your accounts receivable and make sure they tie into the general ledger or your balance sheet. You know, you have an over-under billings that you do with your summary of contracts. You have your fixed asset depreciation schedules you do work on. On your liability side, you make sure your aging ties in. You make sure your liabilities on your payroll taxes tie into some sort of computed balance. Your workman's comp, general liability, over billings, all your payables, any notes payable, you tie to your amortization schedule. So if you prove what you have, which are your assets, and what you owe, your liabilities, the difference is your equity. And so by proving your assets and your liabilities, you've proven an equity position. So what an income statement does is it measures the change in equity position. There is an exception, like dividends or dividend distributions would be thrown into the mix, but let's say you have no dividend distributions. The difference in equity from one period to the next is going to be your income statement. So if we look at a comparative balance sheet, we have an equity position at the end of 2012 in this example of 246. The difference between the equity at the end of 2013 and the end of 2012 will be your net income if you don't have any dividend distributions. So this is a December statement, but this is sample data. The concept is the change will be in here. So the change from December of 2012 to January of 2013 in our sample data will be an $85,000 net income. Okay. If you tie this into your job cost, which is what we did over here, we took our job cost and we compared it to our income statement, and our general ledger versus job cost billing differences are here. So this is where we tie our job cost into our income statement. So our job cost is based on the cost that hit the jobs. The difference between your job cost and your general ledger which is your total cost of construction, basically cost of revenue here, and the job cost that hits your summary contracts will be your over under allocated indirect costs. So the loaded labor factor that the estimators are looking for, this is a good report here to pull that out, can be reasonably relied on if you don't have any over under allocated indirect costs. So you look at this particular report, the labor performance report. It shows more than labor, but on the labor it'll give you a rate. What was your actual rate? Actual hourly rate here, $46.67. Budgeted hourly rate was $40. So the rate variance is 6.67, and you've got a production variance here and a rate variance here. So on your labor you'll have two types of variances. So it's good information for the estimators, and they're always very interested in that. So that's how you know your numbers are reasonable on your rates. By having your over under allocation trued up. Or if it's close to zero, then you know your rates are okay. So here we have so the loaded labor factor, then where do you set your percentage burden in the system? Under utilities, preferences, and burdens. Utilities, preferences, and burdens. If you want to allocate it in another way, retroactively or through the system will post journal entries into particular cost codes if you want. If you want to do it another way, you'll use that burden utility grid. There are a few other burdening concepts in the system, so if you're still not getting what you want, do a support call and we can help you with that. So the blue numbers on the reports indicate what? They indicate an on-demand sub-report. So if we come over here to job cost, job list, and we click this particular sub-report, you'll get a bunch of blue numbers on this report. So what a blue number will do is it will pull up a completely different report that substantiates the amount. So the $63,762, if I click on that cost to date column, I'm going to get a job cost report. If I go to the bottom, I have the 63,762. Okay, so we have demo data that's a little goofy. Here's a ledger type report. We'll show our invoices and receipts on the vendor customer. That's the same report we put in under customer ledgers and vendor ledgers, same report, okay? So those can be made on-demand sub-reports. So a lot of different reports. So it's, hopefully everyone's using some version of the dashboard reporting. So what are the two types of drill downs in the system? We have on-demand sub-reports and we have drill down to detail. So if we come back over here, we can illustrate the concept. Let's see what report we'll be able to use. This accounts receivable. This would be drill down to detail. There's only one line item in that. If it had many line items, it would show all the detail. So from this report, when we click on the ledger, it brings us to an on-demand sub-report with different column headings. If we double-click on the detail, double-click on it, we'll get into more detail. So that's a drill down to detail report. The income statement is probably a better way to illustrate that. So if I hit the equipment rental, I'll get the detail of all the activity there. That's drill down to detail. They're the same report, same column headers essentially. Here it's a completely different report that we bold in. how are indirect costs generally estimated? They're generally through labor. Okay, so same concept as burdening. So if we want to burden, we're going to burden the jobs the way they're estimated. Is the concept. If we look at an income statement, we can analyze how an estimate might look versus the income statement. Obviously, this is a summarized estimate, but here we have a bid, we have direct costs, we'll figure, then we might have lots of line items where we come up with our labor, material, sub-equipment, and other, but we're figuring out what our direct costs are. And we're probably figuring out what our burdened direct costs are. So we come up with a total project cost, and then we'll apply profit and overhead at the bottom. Here we're applying a 20% markup. So 20% of the 22,000 is 4,400. And so our bid amount is our profit and overhead plus our projected costs. An income statement basically starts with your bottom line on the bid, and that would become your revenue. And then you got your direct costs that have come in. You have indirect costs that you've allocated, hopefully up into your direct costs. And you've got your total cost of revenue, which would be the total projected cost. Our gross profit is the same thing as saying profit and overhead. We have operating expenses, which would be our overhead, and we have income from operations, which would be our profit. So that's how you would correlate the concepts. So an income statement is really just a recap of the total of your estimates for a period of time. Or that's another way to look at it. And if your projects started and completed the period, then it would be a recap of the projects you worked on. But you generally will have projects that carry over, so from the end of the previous year and the end of this period. So it's not exactly the same. As far as cost types are concerned, here's a grid where we identify some of the different types of expenses that will hit your company and whether they're direct costs, indirect costs, or sales G&A. So a good understanding of indirect costs and what types of costs should be there versus what types of costs should be in your sales G&A can help you tie your accounting process to your estimating process. So estimators are generally pretty good cost accountants in that they'll visualize their job site, they'll see what's on the job site, they see the costs that go into the projects as far as labor hours, materials, what your field vehicles on the job site. When they think of the labor, they'll think of the health insurance and the 401k and the payroll taxes. And so they usually have a good visual of what really goes into a project. On the accounting side, we just need to match that visual. And it's not as easy because we don't visualize, as accountants, we don't visualize the job site. They have an advantage in that they do, and they know basically what goes into a project. But if we look at some of the costs, I think that'll help us. Depreciation on a copier that's used in the office, obviously it's going to be operating expenses. Depreciation on a copier that's used for plans or bids and actual costs. So maybe, in which case the copier, the portion of the copier that's used for actual costs after you get the job would go into indirect costs. And the depreciation on the copier that's used for your bidding process would go into sales G&A. So sales would be in the pre-job concept, and operating expenses are pre-job. So anything, whether it's an estimator, plans that for a job that you haven't received or you haven't obtained yet, that all goes into G&A. And once you receive the job, anything that you incur that relates to the project is indirect or direct. Okay, so depreciation on a project manager's vehicle is going to be indirect costs. Depreciation on an estimator's vehicle is going to be operating expense. If they're the same guy working bidding and project management, then you could have a mix. So depreciation on field equipment is going to be indirect costs. When you incur that depreciation, it's difficult to apply to a particular job, so you record it as indirect costs. Travel to look at a job to bid is going to be sales G&A. Health insurance on field employees, office and mechanic. The office part's going to be G&A. The mechanic's going to be indirect. And the health insurance is going to be for the field is going to be direct if it's $1 per hour percent of gross. Otherwise, it's going to be indirect and applied to the direct. Shop rent, warehouse facilities, those are typically considered indirect costs in generally accepted accounting principles. Fuel on a field vehicle, generally going to be indirect costs unless the vehicle is on the job for a year and you know you can apply it directly to the job. Office managers' health insurance would be sales G&A. Non-productive field labor, indirect costs. Repairs to a skid steer, indirect costs. Mechanic labor, indirect cost. Interest on a piece of equipment loan would be indirect costs. Interest on an operating line of credit, that doesn't fall on any of our three major categories. It actually falls under other income expense, and it's considered a cash flow item. And the reason you don't put it in sales G&A is because you calculate your break-even point in using your sales G&A, and we'll cover some of those concepts later. Anything that has to do with your cash flow is going to be other income expense, unless it's something you've considered in your estimating process. So let's say you're going to do a large project and you're going to be able to get a discount on materials, and so then you put that in your estimate. So in that case, you would serve to reduce your direct costs or your direct costs. Now, if it didn't have any, if the estimate didn't consider the discounts, then it should go into other income and expenses. Hotel expense on an out-of-town job is obviously direct costs. Now, with the three major sections in your income statement, direct costs, indirect costs, and operating expenses or overhead, that's one concept. You also have a concept called fixed versus variable costs. So if you take a college class on cost accounting, they cover this pretty heavily, and they'll tie that into your direct costs, indirect, and overhead concepts as well. But fixed versus variable, let's just look at this chart real quick. Direct costs are costs that can be specifically identified to a project. So they're very variable. If you don't do any projects, you're not going to incur any fixed costs. That's the theory. Indirect costs are job-related costs that are difficult or impractical to apply. There's generally a fixed and a variable component to your indirect costs. For example, your field vehicle expenses. If they're sitting in the yard, you would think that they don't really depreciate. But in accounting, we depreciate it regardless of utilization for the most part. So in that case, it would be a fixed component. Okay, so home office overhead, operating expenses, they're considered fixed, even though if you increase your workload quite a bit, you might end up adding people to the office, but the theory is it's fixed. And when we calculate some of your ratio analysis, the fixed versus variable, and these categories, they mean a lot more if you do that correctly or follow the logic. And when you follow what's considered the norm or standards, then you can compare your ratios, the ratios of your company with ratios of other companies in the industry. When we do our annual conference, we actually have a CPA firm that pulls those numbers together for the companies that attend the annual conference if they want their company compared. They'll do that in a confidential way. So anyway, so direct non-job account, GL accounts. Okay, so let's cover. I think we're wrapping up our concepts in this. We're probably going to cover some of that in our next session. Let's get through the rest of this so we can finish up. So gross profit percentage is a percentage of what number, and that's a percentage of cost. And then gross margin percent is a percentage of what number, and that's a percent of revenue. If we look at this income statement, I would say it's typical for an estimator to mark up the project cost. Okay, sometimes you'll see where they'll do a margin, and the margin is really based on the eventual bid amount. But generally it's based on cost, and that's a markup percentage. A margin percentage is what you see in a typical income statement, where you're doing a percentage of the revenue, where the estimator is doing a percentage of cost. So if you're interviewing the estimator and you say, what kind of margin do you have on that project? And he says 20%, you need to make sure that he doesn't mean 20%. You should be saying what kind of gross profit, not what kind of margin. So that's a terminology issue and a gap between accountants and estimators. So a percentage of revenue is your markup margin. Your markup is a percentage of cost. So gross profit in the accounting process is what the bidding process, it's your profit and overhead. So we covered that in this concept here. So profit and overhead is the same as gross profit. Gross profit consists of what two subcomponents in your income statement? it consists of operating expense and income from operations. Okay. So operating expenses and income from operations. So operating expenses is another way to say overhead, and income from operations is another way to say profit. So your accounting process needs to support your estimating process, and that's why we need to have the two tied together conceptually. Your job cost, you job cost to what number in the income statement? You job cost to your gross profit, and that's a generally accepted accounting concept. If you take the cost accounting class, that's what I remember when I remember reading that in my cost accounting book. So you job cost to your gross profit. So anything above it should be in your job cost. Indirect costs, G&A. Operating expenses should not be in your gross profit. In the estimating process, you come up with your cost, then you apply profit and overhead. So same concept. Job cost in the general ledger, job costs in GL should be off by what number when comparing the job schedule? It should be off by the over under allocation of indirect costs. We come back over here, look at our income statement. Your job cost, total job cost is going to be here in your income statement. It'll include all of your indirect costs. The indirect costs that got applied up into your jobs will be in your job cost. Any indirect costs that didn't over or under allocation will not be reflected in your job cost. An income statement to an accountant is what to an estimator? It's a bid. So back to that tab, bidding versus accounting. How do you get the detail of your billings by bill code? Here's just a, and the on-demand sub-report, this is a support call we get all the time, so we threw that in here. The on-demand sub-report in the first column of the job list. So the standard on-demand sub-report, if you go into this column and you click, like the Greeley job, the demo will show you by general requirements, these are the invoices that hit GL, the general requirements, each cost code or phase. Every bill code, I guess, is what this is. These are the bill codes. So this particular schedule value line item was billed 3 times those amounts. Okay, so that's a good thing to know, right? So that covers the concepts that we wanted to address in the first session. So in the next session, we'll cover these items, and hopefully we'll get going on time next week. I appreciate you guys attending.